Hello, and welcome to this 21st post of Investing Not Rocket Science. Investing doesn't have to be rocket science, and this is our non expert guide to portfolio management. Let's do a quick recap. In the first episode, I defined a basic portfolio framework. The objective of this $1 million portfolio is to beat inflation and an equity index. I intend to actively manage this portfolio without the use of leverage with a time horizon greater than 5 years. And the investment universe I'm looking at are the developed and emerging markets. The benchmark index is the MSCI Investable Market Index. From posts 2 to 20, I have evaluated 67 stocks and 4 bonds, and this portfolio is long 15 stocks and 1 bond, and it's short 1 stock. You can read all about it on our website www.claritech.app. Okay, today we're going to look at a quick financial market update, a portfolio review, and an earnings overview. The post begins with a quick financial market update. Stock markets were mostly up last week. The Euro Stocks 50 and the DAX 40 are closer to their all-time highs. Bond yields rose. Gold is closer to its all-time high, and crude oil was up 2.14%. Some of the economic data that came in last week, there was some positive surprise from the inflation data in both both in the US and in the Euro area. However, core CPI continues to remain a concern in the US. Of the economic data that came out last week, post which there's a portfolio update. This is obviously the most important part. This is the portfolio that we are looking to build. The portfolio is up 5.1% in the last 2 months, and compared to the benchmark, which is up about 0.59%, the Sharpe ratio is 4.21, the Sortino is 6.94, and the standard deviation is 0.38. Excellent risk measures there. The portfolio is obviously outperforming the benchmark index as well, which is very good, and all asset classes have contributed to the positive performance in the portfolio. And that's what the portfolio looks like. The largest gainers are Alphabet and Glencore, followed closely by Maersk and United States Steel and Infineon Technologies. Deutsche Bank continues to remain the bank with the largest loss at the moment, at about minus 12%, while Citi is close to break even. And if you remember from episode 16, we initially picked up these stocks in the beginning of March, and by the end of March, after the entire Silicon Valley Bank collapse and the turmoil that hit the financial sector, these two stocks were down. The Deutsche Bank was down almost 20%, and Citigroup was down almost 12%. And I re-looked at the portfolio in episode 16 and decided to increase the exposure to these banks post that evaluation, and that's the reason why we are almost at break even where Citigroup is concerned. So those were some exciting times. Okay. In terms of regional exposure, US is at about 35%, Europe is 56%, and Asia is at about 8.47%. In terms of asset class, equities is at about 41%, fixed income 30%, real estate 5%, and the rest of it in cash. In terms of sectoral weights, the largest weight here is on the financial sector, followed closely by the industrials. All right, and consumer cyclicals at about 5.2, real estate at about 5%, telecom at about 5% as well, and technology at about 7%. Cash is at about 23%. The rest in bonds. Post that overview of the portfolio, we go into the earnings. We're going to look at Citigroup. It announced its results last week. And Citigroup's overall financial performance has improved quarter on quarter. This is the last 12 months trailing 12 months data for the last 5 years. So you can see here the top line and the diluted EPS is edging upwards, which is a good sign. And the revenue growth and operating income margin and unlevered free cash flow, all of them have shown some improvement. The only area where Citigroup fell was in the shareholder yield. Regardless, stock was up almost 4.5% on Friday. JP Morgan also announced its results, and you can see here the revenue and the diluted EPS is ticking upwards for JP Morgan. So top line, bottom line is looking good. It beat analyst expectations on both. Revenue growth has improved, operating income margin has improved, shareholder yield and unlevered free cash flow margin both have dropped vis-a-vis last quarter. The other bank on our watch list, which announced its results last week, was HDFC, and HDFC shows improvement in revenue growth and operating income margin. Shareholder yield and unlevered free cash flow has gone down. However, bottom line and top line, they're both showing improvements quarter on quarter. Okay, the other firms that announced its quarter 1 results, United Health. You can see here that financials are improving, and the same with its free cash flow as well. BlackRock also announced its results, and you can see here the trend is downwards on the top line and the bottom line. Unlevered free cash flow, it's kind of stabilizing here at the moment. Okay, so that's a quick snapshot of what is in the 21st post of Investing Not Rocket Science. I hope that you will visit our website, www.claritech.app, and read the blog completely, or visit our social media for the links. This is Investing Not Rocket Science, a series on building and managing an investment portfolio. None of this is expert advice. I'm just learning alongside you. Thank you for watching. Bye-bye.